So, are you trying to pick a bottom, trying to avoid those smelly fingers? Well, in this video today, we're going to try and run through a few different things that give us an indication as to when those bottoms are starting to play out so we can keep our fingers nice and fresh and smelling clean. Just before we get stuck into it, keep in mind that any advice contained in this presentation is general only. It's not tailored to your personal circumstances, and you therefore need to decide for yourself as to whether it's appropriate to you. As you can see, the market's had a pretty strong sell-off, right? And obviously a lot of you are watching this video to try and figure out when that selling is going to end and when's a good time to jump in. No doubt that all of us are going to be, salivating over the current bargains at the moment. But first, we kind of need to talk about the longer term versus the shorter term. I wouldn't blame you if you decided to jump in now. If your horizon's a 5 to 10 year outlook, you could look for some cheap bargain stocks that are clearly cheap out there, right? And considering that some of them are probably blue chip, they're going to last a good while into the future. And even if you bought them now and suffered a bit longer, I wouldn't blame you for picking some of those up. Furthermore, or more importantly, you could easily just buy the index, right? You're welcome to focus on a sector. You're welcome to buy the XJO. You can look at STW or A200 as an ETF. And, all things considered, those things should last fairly into the future. And if you went through a bit of short-term pain, as long as you didn't need that capital, or you didn't foresee yourself needing that capital anytime soon, it's something that you could just hold on to for the next 5 to 10 years. But that's not what we're here to talk about, really. What we're here to talk about is a little bit more to do with shorter term timing, right? Specifically, is this the bottom? Is now the time to get in? And unfortunately, it's not a question that is a simple answer, right? And as we go through this video over the next 10 minutes, we're going to run through a few key indicators that we like to look at in order to help us predict when the market's starting to bottom out and when perhaps is a better time to time your entry, so to speak. Now, what we're going to do is we're going to run through a few different technical indicators. We're going to go through some of the key supports that are present in our market at the moment and why those are important. We're going to touch on the 200-day moving average and have a look at measuring the market as to whether or not it's oversold, and how typically far away the market gets from the 200-day before it starts to bottom out and turn around historically. We're going to look at the Bollinger Bands, which are a great indication of volatility. And we're going to touch on a couple of reversal patterns, which typically happen at the bottom of the range to give us some indication as to where the future movement would be once the market has calmed down. So just quickly, there is a bit of a difference between fundamentals and technicals. Now, fundamental analysis is the idea of looking at the health of a company, the health of a sector, of the market, looking at numbers, P ratios, their future guidance, how much money a company earns, that kind of deep analysis into a company's earnings, right? Technical analysis, on the other hand, is about looking at past price data in order to predict future price movement, all right? Now, technical analysis is better for the short term, and fundamental analysis is better for the long term. And people, you might disagree with me, but ultimately we find that in the longer term, fundamentals are going to play out. And so when I said earlier that if your investment horizon's 5 to 10 years, then buying the index now is fine, right? It's probably fine. That's because fundamentally over the long term, these stocks that are looking cheap should go back to normal value, right? Technicals, on the other hand, are much better for sorting out that kind of day-to-day chaos or that intraday chaos that we see in price movement. Things acting not on a fundamental level, but more on an emotional level, right? Technical analysis is about looking at the past history of price action and applying that to the current situation to help give some confidence about trading the short term, right? And it can just help time our entries a little bit better. So let's go have a look at a chart. What we can see here is that the market, when it does fall, as I said, it falls to a particular key levels that we've seen play out in history. Now, during that first bout of fear selling, we found that it fell to about 6,600. Now, 6,600 historically played out back in, say, November, December 2020, all the way through to arguably maybe April. So there was 3 to 4 months, give or take, where the market liked to hang around 6,600, call it to 6,800, somewhere around there, right, for a very long period of time. So I don't think it's any coincidence that our market fell to the same level after that first bout of fear selling, right, and stalled there for a few days. Once the fear selling renewed last Friday and we saw that another notch down, again, we found that although the selling may be unpredictable, that it did stall at another key level. Now, with 6,400, we actually have to go back a little bit further, all the way back to August 2019, where you can see it was a bit of a level going through here. Now, is that the most reliable level? No, but the market does like to stop at these levels that have played out historically. And just to give you an idea, if we do see further selling, which is certainly on the table, then the next key level for me would be down at 6,200, or roughly there's about, right? Now, whenever I talk about these levels, I'm not being too precise. You know, you have to give or take 20, 30, 40 points or something like that, right? Which makes it more of an art than it does a science. Now, the reason why I picked 6,200 is one, because it's relatively close. And two, you can see after our COVID crash, which was throughout this period here, that after the initial burst of buying, we pretty much stalled there at 62 and managed to hold that position for, you know, from let's say June 2020 all the way through to November 2020, right? So that's several months of the market unable to get through that 6,200 level. Obviously, it was a very prominent level. And so again, if we do see that selling, then 6,200 should be the one that that we should fall to, or thereabouts, right? So again, this is not necessarily enough confidence to help predict a bottom. This is not enough confidence to start trading today, obviously. This is just one piece of the puzzle, because technical analysis, like fundamental analysis, is simply a confidence game, isn't it? Right? And support levels and other forms of technical analysis principles, we pull them all together in order to gain confidence to make a trading decision. This is only just one piece. The next thing I want to have a look at is the Bollinger Bands. Now, the Bollinger Bands are these orange lines that are straddling the share price. Can you see them here? And this pink line here is the median of the two, okay? And the Bollinger Bands will always straddle the share price, as you can see, or the index price in this case. It's not again, it's not a particularly important indicator, right? But again, it's just one piece of the puzzle that we add together in order to form a view. What we can notice about the Bollinger Bands is that, you know, particularly in, say, trending stocks, whether it be downtrending or uptrending, in this case, we're looking at it from a downtrend perspective, you can see that when it does reach the bottom, it does like to return to the median. Reaches the bottom, returns to the median. If it can hold strength at the median, then often it can return to the top of the band, right? So after it's finished touching one side of the band, the first leg is to the median, and then sometimes the second leg is to the top of the band. If the stock is downtrending, it's at these points that you need to start to be worried about bull traps. It's at these points that you need to start considering perhaps selling your positions if you're a trader, right? Because the characteristic of a downtrend is actually lower peaks and lower troughs. And we can see that in this chart, right? Sometimes it's more aggressive, where we got a lower trough, lower peak, lower trough, lower peak. Sometimes they're a little bit slower, and that's what we're kind of seeing at the moment, where it's a lower trough here, a lower peak there, and now we'll go on to make a lower trough at some point. So it's good for these downtrends because, of course, you're going to get some relief rallying. That's how you make lower peaks. Of course, you're going to see upticks in a broadly downward moving stock or index, right? That's the definition of a healthy downtrend. The question is, at what point does it start to turn around again, right? At what point is it not the bottom of the market? Like, how do you avoid being trapped into believing it's the bottom? Well, you need to start to be thinking carefully when the market first moves back to the medium, and then secondly moves back to the top of the band. Now, that could take weeks, it could take months. Unfortunately, again, it's just one piece of the puzzle. We'll come back to the Bollinger Bands in a moment when we start to look historically, but for now, the next thing I want to talk about is the 200-day moving average. Now, the 200-day moving average is this thick red line here. I've also got the 50-day moving average and the 100-day moving average. Now, I'm not going to go into how the 200-day works, just like I didn't bother with the Bollingers, but in essence, the 200-day moving average takes the closing price for the past 200 days and averages it out, right? Should that mean anything to you? Not really, for the purposes of what we're covering today. The 200-day moving average, what we can do is we can measure from it, right? And we can look historically, when was the last time the index was below the 200-day moving average, and how long did it stay below that? Well, you can see the last time it was below here, it only moved about 7 to 8% lower. Well, right now we're actually the yesterday's lows were about 10 to 12%. Let's call it that, right? So we can't really use this as a comparison. The other thing to note is the reason why we can't use that as a comparison is because right now we're trading in a downtrend, whereas that really arguably isn't a downtrend. That's just a bit of a pullback, right? Remember, a downtrend's characterized by lower peaks and lower troughs. So we actually have to look historically further back and see at what point, how far away from the 200-day moving average does our market get before it starts to bottom out? And so we, unfortunately, or perhaps fortunately, we have to look pretty far back to see the last time that happened. So for example, we can look at the COVID crash, right? Back in early March 2020. This is a bit of a different market. That's not a downtrend, that's a crash by all sense of the word. Yeah, that's an elevator on the way down. That's not taking the stairs down, is it? Right? So even this is not particularly comparable, but just as a side note, that was about a 30% fall from the 200-day moving average. That was way overdone, right? But global lockdowns, slowing economies, people are literally dying of a virus like it's from some movie. You know what I mean? So again, not particularly comparable to the current market conditions. We actually have to go all the way back, and probably the closest evidence I've found is back in 2018 to 2019. So it was Christmas 2018 that we actually started to turn around from the recent downtrend. You can see throughout this period, we're making lower peaks, lower troughs, right? So I would say similar to what we're seeing at the moment. It followed a decent bull market, right? As you can see, it's not particularly great, but it's still what you'd call a bull market. So I would say fairly comparable to what we're seeing at the moment, albeit it was a few years ago. It was really at kind of say this point here down the bottom that we started to turn around. And you'll notice that it's also about 10% away. So roughly where the market is currently at the moment. And this is the first kind of evidence that we're seeing that maybe we are going to actually find the bottom somewhere around here. Now, is there really a difference between say 9, 10, 11, 12%? Not really, because we're talking small numbers over a longer period of time here, over a grander scale. But it's roughly when it gets to around this number in the past that we did actually start to turn around, right? If we were going to look for a little bit more evidence, we would have to go further back even more. And I think the last time we saw a bear market dip below the 200-day was actually back all the way in 2015. Because believe it or not, I did do my research before recording this video. And you can see 2015 was really like a really strong bear market, as you can see. So maybe not completely comparable. As they say, the market doesn't repeat itself, but it rhymes, right? So not completely comparable. This is a much longer downtrend throughout here. But it was arguably when it got to about that, say, 10 to 12%, as you can see here again, that it started to bottom out and go back up. Even, at the lows here, you're looking at a similar kind of number, 10% there, and it went back up, right? So the moving average is actually pretty killer, right? You can actually, when the market gets to about that 10 to 12%, somewhere around that number, the market actually does start to turn around. This kind of marks the bottom. It didn't dip too much lower than that. If you bought the index here and then it ended up going down here before going up, are you really going to care too much? Probably not, right? Even as a trader, even as buying stocks, you certainly need to be aware, and you need to be aware of short-term movements. But I think that's a pretty good indicator, right? That 200-day. Again, only one piece of the puzzle though. The other thing that we want to actually keep in mind, and this is going to be probably the simplest out of all of them, aside from those support levels, is just a simple trend line, right? What's interesting about the current market is that we haven't really broken the downtrend line. And I'll just quickly draw that in for everyone. So you can see the trend line, I'd probably draw it something like this, right? Now, it's not perfect, and I promise you I'll readjust it later. It depends on how thick your texture is and all that type of stuff, right? But that downtrend line, what we can do is, as you can see, we can project it into the future. And we haven't broken it yet. And that will still cause downward pressure on our market and stop that kind of V-shaped recovery that perhaps some people are expecting. If I go back to 2019, and I'll do it quickly. If I go back to 2019, you'll notice that the recovery was kind of only felt certain once that trend line had broken. So it was following this trend line pretty picture perfect, as you can see, and then it broke it and it started to move higher. So in that circumstance, we're actually probably looking for the downtrend line to break before we can truly call the bottom. And I'll go back to the chart, back to the present day in a moment, but if we can just quickly compare that to 2015 once again, just to do our due diligence. 2015 is a much broader downtrend line, and we could maybe argue something like this, right? So even when we got those 10% away, we had that downward pressure. And that's what we might be seeing in our market going forward. We might see several months, even a year or two, of this kind of lamentation before we start seeing the rallies again, perhaps, right? Again, only one piece of the puzzle. So it's about bringing all this stuff together in order to form a view, right? And keep in mind, these views are dynamic. Okay, they're not static views, right? They change. If you ask me in a month's time, this all might go out the window. I don't know. We'll have to do it again. But for now, the downtrend line hasn't broken, has it? Right? If we draw it, if we look at our current market, so we might see that whippiness. We might see that crazy kind of market where things are up and down. Perhaps further falls are to come. Who knows? Before we start to see the bottom. The final thing that I want to run through is reversal patterns. And this stuff's pretty key, and this will kind of add the final piece of the puzzle for you, albeit there's other stuff that you can look at too that we're not going to cover in this video today. If we're reversal patterns, and I just want to switch back to my slides here. Give me one moment. So reversal patterns are actually really kind of interesting, right? If we're looking back at that Christmas 2018, right, as the most recent past example of the market dipping 10% below the 200-day, right? We can simply draw the downtrend line in, as I did before, and you could draw in that support level there, right? That's fairly simple analysis, and a fairly common pattern that people like to talk about is called a descending triangle. As you can see, this shape here is making that triangle pattern. You can see that day there, it broke out of the triangle, it broke the downtrend line, and it moved up, right? But at that particular point, you might not necessarily have confidence that the market's simply going to rise, because there's plenty of resistance levels in between, and you might be battered and bruised, your psychology might not be in check, you just might not necessarily have the confidence to get in. So you want to try and add some more layers, right? Instead of kind of concluding your analysis there and shrugging your shoulders, what else you can identify is, again, those reversal patterns. So the one we're going to look at here is the inverse head and shoulders. Now, a normal head and shoulders just played out on the US market, the S&P 500. And in truth, our market follows them closely, very, very closely, right? So when we talk about our market, it's really only half the conversation unless we go and look at the S&P, which we might do in this video if we have time. In this particular chart, though, what we saw was the descent, right? And reversal patterns only happen at the bottom of the trading range or at the top of the trading range if it's a bull market. It created a left shoulder, right? Now you got to remember it's like an upside down head and shoulders. Okay, so there's the left shoulder there. There's the head there, right? And then there's the right shoulder there. Okay, so it's like if you flip that up, it'd look like a head and shoulders, but this is why it's called the inverse head and shoulders, right? The pattern's actually only confirmed once what you call the neckline is broken. You can call it the neckline or the collarbone, right? Once that breaks, the pattern is confirmed, okay? And you can see on that day there, it actually did break. And if you knew that, and if you knew how to identify that reversal signal, you probably would have had more confidence to enter a bullish trade and hopefully make some money. What else is kind of cool about reversal patterns? They often indicate how much movement to expect once the pattern has broken. So in this circumstance, right, the distance between the head and the neckline is roughly what you'd expect once it is broken. And you can see it basically did that, didn't it? It's not perfect. It's not like, you can get out your ruler and measure to the decimal, obviously, right? But it is pretty good. So the distance from the neckline to the head is roughly the distance that you can expect in the immediate move after the break of the reversal pattern. Now, obviously the stock can keep going after that, but you can see it consolidated for a bit once the pattern had concluded, just to kind of see where it's at. Now, What I'm going to do is I'm going to jump quickly back to the chart and show you again back in 2015, and I'll probably show you the US market as well. Hang on a sec. So scrolling out to the 2015, because we just did 2018, right? You can see that the downtrend line was still in play, sure, right? But you saw the same inverse head and shoulders, didn't you? There's the left shoulder there. There's the head. And there's the right shoulder there, right? And the neckline is about there, roughly through there. We saw the break here, and it betrayed us a little bit, but ultimately ended up going up and stabilizing. Do you know what I mean? And it was a rocky rise, and you had the kind of that shallow uptrend, but you could certainly argue that was the bottom of the market, couldn't you? And it was indicated by several things. We had the 10% away from the 200-day moving average, we had the break of the downtrend line, and we had the keen reversal pattern there. Okay? Now, it didn't play out as perfectly as 2018 did. These things don't always do that, so you've got to keep that in mind. But it's not bad, hey, right? It's not a bad way to help pick the bottom of a market. Certainly better than doing none of those things, right? Now, I'll just quickly jump across to the US market. And what's interesting about the US market is we've actually seen the reversal happen at the top of the range. So this is the S&P 500. This is what I call the US market. Okay, now obviously they have the NASDAQ, which is tech, and they have the Dow, which is like just big top 30 companies, well, not top 30 companies, but big 30 companies. This for me is the US market, right? And you can see they had a really nice run up through the recovery after COVID, and they formed the same head and shoulders pattern, right? A very similar head and shoulders pattern. So you've got the left shoulder here. It's very broad. You've got that little left shoulder there, the dip. There's the ugly looking head. It's a head that only a mother could love, right? There's the dip down, and then there's the right shoulder, right? Now the neckline doesn't have to be horizontal. We can always draw necklines with a slant. That's totally fine, right? So I'll just draw that in there, just to make it a bit clearer. What's interesting about that head and shoulders is if we draw it from here, right? Just try to gather the distance, remember. We draw the break there. It actually projects the US market back down to say 35 to 3,600, right? Somewhere around there, yeah? And we're starting to get to that as well, as you can see with the US. So this kind of coincides with our own market kind of bottoming out, okay? Now, you're welcome to go back and do the same analysis for the moving averages, right? How far away does the US market get before it turns around from the 200-day moving average, right? I haven't done that in this video, but you're welcome to go do it yourself if you're interested. We're starting to see that play out and complete now as well, okay? Now, again, things could fall further. That's the funny thing about all this stuff is that this video might be useless in 3 or 4 days' time if the market tanks another 1,000 points, right? But this is just one way to help perhaps time your entries into the technical analysis area a little bit more. So this is just, like I said, one piece of the puzzle. It's a very interesting way to look at markets from a timing perspective. Again, fundamentals are going to play out no matter what, right, over time, and they can certainly drop markets very quickly in the short term. Just keep an eye out for key levels, key support levels. Look for the downtrend lines to see how they're faring. Look for reversal patterns, and just keep an eye on how far away this market gets from the 200-day moving average, right? Another good indication is the Bollinger Bands. If you are looking to trade the relief rallies, right, those kind of bull traps as they're called, you can try and trade them back to the medium or even the upper band if you're feeling kind of ballsy. But otherwise, if you're looking for a more medium-term investment, then buying the index now is not necessarily a bad time, but maybe wait out for those double bottoms or those inverse head and shoulders to play out first. One last thing, if you are interested in learning more about this type of technical analysis, if you're interested in learning how to trade properly, you want to learn how to pick direction effectively, we do run an education program that goes for 4 months. It's called the Traders Circle Masterclass, and it focuses on one-on-one mentorship with an advisor. It includes 2 full weekend face-to-face workshops and 4 months of ongoing online training. During the workshop, we'll cover picking direction with technical analysis, covering a lot of what we've covered today, plus more. We'll teach you basic and advanced trading strategies, and we will cover risk management, all taught in the framework of a set of trading rules that us as professional traders use on a daily basis. But until next time, if you're interested in having a chat to me or any of the advisors here about anything that we've covered in the video today, or you want to have a chat about what's going on in the market, you're welcome to pick up the phone and give us a call on 03-8080-5788 or emailing us at support@traderscircle.com.au. But until then, good luck and happy trading.